Hey everyone, welcome back. Today's market. Well, it had a bit of a weird start, kind of fumbling around for the first 20 minutes before the opening bell, but after that, it was pretty much smooth sailing. A collective climb higher, staying strong all day. No real pullback. Semiconductors and the seven big tech names were definitely the engine today, driving everything. Healthcare, led by Eli Lilly, was also a big winner, topping the SPS 11 sectors. Utilities, on the other hand, had a rough day. So what's interesting is that stocks that often feel like they at odds with each other, like big tech, semiconductors, and software, they all went up together today. It was one of those days where everyone seemed happy, especially for those of us who tend to concentrate our holdings. Many of our key stocks saw collective gains. This is actually quite rare, probably the third trading day in almost 2 months where we've seen this kind of broad positive movement. Usually there is a pretty clear division between them. Now for the news side of things, it's still pretty messy out there. The US reportedly struck a military target in Iran. SABS port for the second time in 3 days, and Iran's Islamic Revolutionary Guard Corps responded by attacking a US airbase. On another note, some media outlets reported that US-Iran negotiations had reached an agreement on a 60-day memorandum of understanding, but this still needs presidential approval from the US. Then right after that, Iran's Tasnim news agency denied the media reports, saying the agreement text hasn't been finalized. So, the Middle East is currently a bit of a parallel universe. What's really happening? What's on the table? What's under the table? It's all unclear right now. Every day, the news shifts back and forth during trading hours, but the market is still pricing things in pretty clearly. For example, Brent crude oil is getting closer to $90 a barrel. Once it drops below that, the market's concern about the current oil supply situation in the Middle East will significantly ease. What we're seeing now is that other oil export sources are gradually recovering, and the global supply of refined oil products isn't as tight as it used to be. So as long as oil prices don't shoot back up, people don't seem to be too worried about what is happening over there. The biggest concern at the time was whether the Strait of Hormuz would remain open, and the fear was that oil prices would stay above $110 and keep climbing. But now that it's dropped to $90, the market is kind of treating it like it is open, whether it technically is or isn't. The market's pricing suggests it's open. We talked about the Strait of Hormuz before and why the market is behaving this way. Overall, the SP situation is interesting. A lot of stocks hit 52-week lows recently and have bounced back a bit. But the SPS Rising Index is actually pretty distorted. People might ask, if the Strait of Hormuz wasn't open, why is the index still up? Well, the SP index has seen about a 19% rebound from late March through April and May. That sounds like a lot, right? But do you know how many individual stocks contributed to that? 10 stocks alone drove 69% of the SPS gains. If you expand that to 20 stocks, it is over 80%. These 20 stocks are basically carrying the index while the rest are just kind of lagging, so that's the current state of the index. Meanwhile, some stocks that are truly affected by oil prices and inflation, like airlines, cruise lines, and travel booking companies, have been struggling. They feeling the real impact. But semiconductors and tech stocks aren't as sensitive to inflation's impact on energy companies and oil prices. So we seeing this two-tiered market right now. We can talk about the SPS overall situation and its point levels later. For now, looking at the SP and NASDAQ's index performance isn't really telling the whole story today. S-market was relatively straightforward, not a whole lot to talk about. I'll just quickly go over the PCE data and then briefly track some of the individual stocks on my watch list, especially those with unusual activity. I'm going to keep it a bit shorter today because it's almost the weekend and I am a little tired, so let's lower our expectations for today. Show first, let's look at the economic data. Today, main data point was the PCE for April. The core PCE price index rose 0.2% month over month, which was below the expected 0.3%. However, the annualized rate rose to 3.3%, matching expectations. The previous reading was 3.2%, and this is the highest level since November 2023. The overall PCE price index rose 0.4% month over month, lower than the expected 0.5%, and the annualized rate rose to 3.8%, matching the expected 3.8%. The previous reading was 3.5%. That's it for today. Economic data. Next, let's go directly to individual stocks. Going down my watch list, first up is Eli Lilly. Lilly found support around the $900 mark during this pullback, and after breaking above its descending trend line, it's been on a steady climb. Today, it directly broke through the last resistance at 1090, opening at 1096. This was a clear breakout. The closing price today was also a new historical closing high, putting it back on an upward trajectory right now. It seems Lilly still has that same issue we talked about before. It hasn't really offered a super low entry point for those looking to buy the dip. The lowest it got was probably around the 871 to 928 range, and that was pretty much the limit because its growth hasn't significantly slowed. Market enthusiasm remains high. People are still willing to accept a relatively high forward valuation. So for 2020, 2026, the target is 1086 to 1448 with a median of 1267. For 2027, it's 1251 to 1668 with a median of 1460. If you own it, you are definitely still holding. Right, if you bought it earlier, as we discussed, you are already in. If you didn't buy it, you might be wondering what to do now. So during pullbacks for good stocks, you really need to decide for yourself. Sometimes once they start moving, chasing them can put you in an awkward position. We need to reiterate the risk here, which is still the growth slowdown we discussed earlier. A slowdown in growth could lead to a decline in its forward P multiple. That's the biggest issue right now in terms of valuation risk from PE fluctuations. Otherwise, its overall earnings performance remains quite strong. Next up is Microsoft. Microsoft saw a noticeable surge in volume today, which is rare for it. Microsoft will soon be holding its developer conference, where it is expected to unveil some new AI models. While they've had AI before, these should be enhanced versions. Today's surge in volume was very clear. Almost a big green candle with only a small upper wick. When you see a big green candle like this, many people who might have been lacking confidence in Microsoft suddenly regain it. The market works in mysterious ways, doesn't it? Honestly, whether you have confidence or not, if you had it during previous market conditions, you probably still do. If you didn't, you probably still don't if your confidence changes based on one green candle or disappears with one red candle. That suggests you might not fully trust the stock or understand its fundamentals well enough. So I'll say it again, Microsoft is solid. It is still my largest holding. The first stage target, slowly climbing towards 498 to 516, represents about a 15% upside. The time frame is uncertain, but it should continue to climb without major issues. IV updated a resistance level for Microsoft here, a small one at 440 to 461, and a medium one at 469 to 490. The upper target's Haven T changed. The 440 to 461 range saw a slight adjustment. Let us take another look at the forward valuation based on the current situation. With the fiscal year ending in June, once the Q4 earnings report is out, we'll be able to look ahead to June 2028. Based on current valuation levels, the price isn't particularly high. Of course, it must be acknowledged that growth isn't as rapid, so based on its historical volatility, a range of 25.3 to 31.5 times earnings with a bit of a discount might work, but you can't discount it too much given the price point that's Microsoft. Now, for a few others that didn't see huge volume, we'll quickly go through them. Meta saw lower volume, so we won't discuss it today. We just talked about Meta a few days ago, so no need to repeat. Lower volume means it's consolidating sideways, just ignore it. Amazon's breakout to new highs is still in play. Today saw a small increase in volume and continued upward movement. It's still quite strong, so no need to worry about it, Tesla. I updated its more detailed key support and resistance levels yesterday. Today, it saw significantly reduced volume speculative interest or swing trading interest. Wasn't on Tesla today, so the price is consolidating, no trend movement. It's still a question of watching for a breakout above 465 or a breakdown below 419. The short-term window for trading is closed. This is where you need to consider the risk-reward for speculative or swing trades. AMD mainly an update on its fundamentals. There's a medium support level at 442 to 453. That is the most recent. Above 453, there's about $50 or $60 of space with no current support below. 400 to 420 is a minor support, and then 334 to 366. So that's the situation for AMD right now. It is still one of those stocks like many others we see where new highs keep being made and buying on small dips just pushes it higher. Ivy talked about the principle behind this before. It's similar to the melt-up rallies we saw several times in previous years when there's a new high and a lot of call options and bullish stock buyers aren't selling, but continuously buying, and those already holding aren't getting out. Then in the short term, supply and demand still favors buyers. This includes a large influx of call options leading to gamma squeezes upwards. Market makers are passively forced to buy because after they sell you call options, they need to hedge their risk to maintain delta neutrality, so they are forced to buy shares. This situation is the opposite of a market stampede. It's an upward squeeze. When it's a downward squeeze, all stocks are the same. This is just about AMD when any stock experiences a one-sided upward trend. It means there's short-term capital pushing it higher. Similarly, if there is a short-term imbalance in supply and demand, and capital flows out in the opposite direction, then market makers become a powerful driving force. It's the same logic as when you are buying puts and they need to sell them to you. They need to hold a lot of underlying stock. Then there's Nvidia. The situation with Nvidia, if it pulls back below 211, as Ivy mentioned many times. If you don't have enough exposure, you can decide for yourself to buy between 211 and 175. My Nvidia position is already full, so I don't have any plans to add or reduce my position. For those of you who don't have enough exposure, you can consider it for yourself. We won't dwell on this too much. Today, it was still low volume. Nvidia, because of its enormous size and market capitalization, requires a lot of capital. Many market participants right now are trading smaller caps, which is is easier. So don't have excessively high short-term expectations for Nvidia. People might ask when Nvidia will jump 10% in a day. That is getting harder because of its market cap. So a slow and steady climb is what we should expect. If it does accelerate, it will likely be when some of the capital currently chasing more speculative growth stocks and smaller caps rotates out. When that money comes back to undervalued stocks, then its gains might be relatively better. Many people worry that if the semiconductor sector pulls back, will Nvidia also crash? Think about this. When semiconductors were surging, Nvidia wasn't surging as much. So it won TB Nvidia's fall that causes the Philadelphia Semiconductor Index to crash. That is the logic. In fact, I believe that if the Philadelphia Semiconductor Index experiences a significant pullback, Nvidia will actually be a relatively good safe haven among semiconductors because its earnings are solid and Haven T deteriorated. Now, we updated on Google a few days ago. All previous plans to reduce holdings have been canceled. The focus is on holding. This is mainly because of the potential for speculative trading when SpaceX goes public, as Google holds a significant stake in it, so it might move with SpaceX for now. I am not planning any reduction in holdings. I'll observe it first. Apple is showing a similar trend, a slow and steady upward push. This upward movement, when it creates a squeeze, is primarily due to a gamma squeeze. And then there is Snow. This, my friends, is what we call an old-timer stock. Only long-time followers might know why this stock is an old-timer. I actually bought this stock during its IPO in 2020, and I haven't touched it since. That was a venture investment, not part of any of my current long-term investment plans. I've told you before, that was money I didn't need. Money I was okay with losing completely. Money I could leave untouched for years. It was a relatively small amount of capital I put into it. That is what a venture investment is. It is not the same as my regular stock holdings. Okay, so I don't usually talk about this stock much because there isn't much to say. Why is there much to say? Because its forward valuation is severely overvalued. It always has been severely overvalued. To this day, even if you generously value it at 60 times earnings, it still wouldn't be worth $200. That is from a forward valuation perspective. After its earnings report, the overall AI-driven situation has been quite good, so it surged 36% in one go. My view here is still that I am still not moving, but I do want to remind everyone about this stock. It is also very much a technical play, a stock that follows technical analysis, so if you are going to trade this company, you need to know that its volatility is extremely, extremely high. Okay, its current situation is that 217 to 235 is a strong support level. That is where today's closing price broke above. The upward movement above here faces relatively little resistance. There are only 3 medium resistance levels. You can take a look: 238, 252, 262, 279. And 292 to 309. There is much strong resistance, so its current situation below is quite stable. As long as it stays above 217, the overall structure remains in the upper half. It's just a matter of when it make its next erratic move. Sometimes it just suddenly crashes. Take a look at the past. This isn't new. It had continuous crashes where you don't even know what happened. Then later, when it is supposed to fall, it still falls. So a 90-point swing in a day is quite normal. So this is a high-risk, high-volatility stock. I'm telling you this because so many people asked me about it yesterday. So today I am giving you my personal advice. Try not to imagine this stock as being too wonderful. It's not easy to trade, honestly. While swing trading might be easier, you need to have a certain level of technical analysis skill. Otherwise, you can easily get whipped around and dizzy. Okay, so this stock is difficult to trade, but recently, after it broke out today, I'll give you a key level. As long as 217 doesn't break, then the upside potential and room for movement are huge, perhaps tens of percentage points in either direction there. Another stock I want to briefly mention, SRG. This stock is quite interesting. If I don't talk about it, people ask why I'm not talking about it. I don't want it to get too much attention. The moment I talk about it, it takes off. The moment I talk about it, it takes off. So I haven't talked about it much recently. When I don't talk about it, it doesn't move. It rebounded and then came back down again. The last time after it broke down, I talked about it. So this time, nothing has changed. It fell, then rebounded, didn't it. I said to treat it as a rebound until it breaks higher. It's a rebound that hits resistance and falls. So I won TB buying during this process. I haven't bought it even now. Some of you might be thinking about buying the dip today. I personally am not that aggressive. Take a look at where I plan to add to my position. From 321 to 405. That's an $80 range. I am planning to add 7% of my position there. I am not saying I'll immediately buy once it hits 405. That's not how it works. This range exists because it's a very broad area of strong support. I don't know if it will stop falling at 405 or at 308. Or at 370, 365, or $310, I don't know. So this position has a margin of error built in. It's not about going all in at 405, right? That's not how I think about it. So Please don't be aggressive. Last time I told everyone not to rush, but some of you rushed. Didn't you? You rushed in, and now you restuck at 450, and the price is high. Don't rush. Don't rush even at 405. Slowly wait for some bottoming patterns to emerge. After all, it's fallen from such a large topping formation. You can see its trajectory. This is a multi-month topping pattern for how many months from 2024 until now? A 2-year topping formation has broken down. Do you really think it can recover that quickly? It's not that easy, so wait patiently. Don't rush. I once said, if you buy and it does go up, you re-waiting. You re-still waiting. Right. Now, if you re in a downtrend that hasn't ended and you wait for a trend to emerge, you re also waiting. But the experience of waiting in these two scenarios is different.